All right. Stocks didn't handle those Fed minutes too well. They weren't handling the rising rates we had before the Fed minutes very well to begin the day with, but really things hit the fan after those last couple of hours. So I'm going to break that down today to see just how bearish that was and whether it's bearish enough to continue what we saw before the holidays. What does this do? What does this move do to that holiday rally that kind of started this little intermediate run? Do we have intermediate pullbacks starting? Are we in decline mode, intermediate decline mode? So we're gonna break all what the charts tell us there and see what we expect to see, especially after such a big move. What does the size of today's move mean? The fact that it got above that 2 and 3% mark for some of these indexes. I'm also going to break down the biggest driver. We all know what it was, but we're going to talk about how that impacted different asset classes today. And then we're going to take a look at a trade idea of a stock that has been very bullish, that has been pretty sideways for the last couple of months, and today really started to fill into a big gap. And we're going to talk about how to trade that gap. So let's go ahead and get started. Today is Wednesday, January the 5th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 like we always do with the market forecast indicator. Again, considering how bearish we were today, down nearly 2% on the S&P, the intermediate line just barely dropped below the 90th percentile. It's actually still in the upper reversal zone. So is the market sentiment line. It's at 80.09, but it's still there, right? And they're both falling, but they're still above the 80th percentile. So that kind of shows you just kind of how bullish that we were, especially around the holidays, going into the Christmas and then after staying up there, and then the beginning of the new year. But this near-term peak, we talked about Monday, like let's see what happens on the next near-term peak, because that's going to be really telling. We're going to get up above 80, especially we're going to get up above, at least above 80, if not above 90. Are we going to start a new near-term rally? We got into bullish territory yesterday, even on a down day, but that's it, right? We are right back down in the bearish territory today. So, I mean, that's a pretty bearish near-term peak. It's about equal to where it was to the prior near-term peak. So it's not really a higher or lower, significant level there. But the fact that it only spent a day in bullish territory, the fact that when it was in bullish territory, it didn't get above the 80th percentile, I mean, that's pretty bearish, right? The typical range is 7 to 12 days and getting above 80, and neither one of those things happened. Just one. And then we closed below a lot of low points, right? All of last week's lows, and then a couple of these days, a couple of those Christmas, the day before and day after Christmas that were so bullish, we closed below their lows of those days, even though they were kind of gap days there. Incidentally, we're still a 0.5% above the 30-day moving average. So, again, that kind of shows you that, as bearish as we were today, we had some room to be bearish, especially in the Dow Jones Industrial Average, which, again, very similar, strong bullish. This was a higher high point, but it was a divergent high point. It was a high with a near-term peak that also did not get above 80. Now, the near-term, we're not in bearish territory, so it's actually not done yet. So we'll see if this extremely low momentum line leads to that. But so it's not quite there, but that is a bearish divergence. And again, closing below that low point would be the change of trend, right? And so that low point, which incidentally happens to be at the 23% retracement of this current intermediate rally, you get below that, and you would start retracing that bullish move. The Nasdaq's a little different. The Nasdaq, we've only had just a little tiny intermediate run going, so I didn't even draw Fibonacci lines for that. It's so shallow. So I've actually still kept this one going. We were above that 23% retracement, like starting a new run. Now no longer. Now are we not only not above the 23 line, we're also not above the 38% level either. We're down 3% today on the Nasdaq. The intermediate line has fallen back below bullish territory. It's not in bearish territory yet, but this may be a very short-lived intermediate run that not only did not get above the 80th percentile, it also didn't get above its market sentiment line. So that would be a really bearish intermediate peak. It'd be like, kind of a fake out type. It would have the impact that a fake out would have, where a stock gets through a resistance level, suckering in a lot of people thinking that it's bullish and then not being bullish, right? And that now you've got really, really weak hands. So this will have the same impact. You know, you sucker in a lot of people thinking, okay, we're back to being pretty bullish here or through the holidays, and then now not so much, right? Now not so much. So that would be, and we're 2.5% below the near-term line back. Not, you know, never did get into bullish territory, and it's back into oversold levels. So an extreme low on the momentum line there. The Russell 2000 was down 3.25%. You know, it had been lagging, like it had been not so bearish. Then the NASDAQ the last couple of days, that changed today. It was down just as much as that. In fact, I think a little bit more by the time it was done. We are back here. You know, we were back. Remember on the Russell, because we had broken below to these new lows. Now the pullbacks go up, not down. So we have been on a pullback to the upside here, getting above the 23% level, getting above the 38% retracement. And now we're back below and potentially back, you know, we'll see if we get back below the 23 and start a new bearish leg lower. We're obviously back below a falling moving average, hence the red line, and we're back below 50 on the intermediate line. So we went from dark green shading, being above 50, back to dark pink shading, being going down, back below 50. And we're just barely above the momentum line, there, or market sentiment line there, and you can see back, you know, not just a smidgen below, but, you know, full 1.25% below the 30-day moving average. So pretty bearish patterns on the market forecast for a lot of these indexes that you know, kind of confirms what we saw on Monday. Like Monday looked good, and we were kind of leaning towards wanting to be bullish, but we needed that extra confirmation, right? That Monday wasn't just a one-day bounce back from oversold technical levels through that holiday, that intra-holiday week. Well, it looks like that's all it was. It was just a snapback from oversold, short-term oversold levels, and now yesterday and then now today especially, you know, we're kind of back to the mood that we were in before that pre-Christmas Santa Claus rally there. Let's take a look at the long-term line, and you can see for the S&P, again, we still don't have a red arrow there. We still have a positive differential, and we're just barely following on the PPO. So really don't have a bearish pattern on the S&P yet. Not the case on the NASDAQ. There's our red arrow. There's our falling PPO. There's our negative differential. So we have a bearish pattern on the NASDAQ on this particular chart from an intermediate basis. And your Russell 2000, you can see, never did get the green arrow on. So it's still below its 10-week exponential moving average, or, you know, we use it as a proxy for the 50-day. So it's back below that big upper shadow. The PPO is still falling. It's almost to zero. So we're almost to a death cross on this chart on the Russell, and you can see our differential is back to being very minimal and potentially breaking back below. In fact, it is breaking very minimally below its moving average there. Let's take a look at the 3 green arrow chart. We had talked about how yesterday, I believe it was yesterday, well, maybe not. Yesterday there was one of these charts that did not have the 3 green arrows anymore. It must have been the Qs, but we finished back up above it. Now we're 3 red arrows. So we've gone from green to pink on the NASDAQ, just like that. But we're no longer green on the Russell, and we're no longer green on the S&P. We got the red arrow on the MACD. We got the red arrow on the moving average. You would expect that will lead to 3 red arrows on both of these. Again, if it's a day, that's fine. But if it's more than a day, then we know, it's not just a one-day bounce, bearish move. And then look at your diamonds. We don't even have a single red arrow on the diamonds yet. That's how bullish the diamonds have been. The Dow Jones Industrial Average. Here's your S&P 500 breaking the 17-day. So potential, we might skip the bullish convergence and go straight to bearish divergence, which is where we're at in the Qs. We are well below the 17-day there. So we are in bearish divergence mode on the Qs, as well as now the IWM as well. IWM, that's why it was so big, because we got back below the point of control after being up above it. We got back below the 200-day moving average after being up above it. And we're back below the 30-day moving average. And so we're back to potentially a new bearish divergence showing up here on, it hasn't crossed below its moving average yet, but it has on the stochastics and a big amount of volume compared to what we've seen here lately. Let's take a look at the oscillators. The S&P's oscillators flirting with the midpoint, so not really as bearish yet. The NASDAQ, however, is. So below 50 easy, below 0. So now it's a matter of, will we sustain this to the downside, because You can see the Russell is also kind of flirting with the midpoints. So we're kind of, I mean, we're kind of at an inflection point where today got us to, today we weren't even close to, before today we weren't close to this inflection point, but today now things could really get bearish tomorrow. And if we open up with a pretty significant gap, if we open up, if we, even if we have just a small bullish gap, and we follow through with today's selling with a similar degree of selling tomorrow, then that will push us past this inflection point to these bearish levels. Obviously below this 23% line, below other Fibonacci lines on the other indexes, and we would be in full-on pullback mode at that point. Keep in mind that the S&P, did have a bullish intermediate trend going. It's actually still bullish, right? It's just weak. It's above 50. It's above the 1, but it's not. It doesn't have that intermediate strength anymore like we did just yesterday, but it's still bullish, right? Your Qs, that's not the case. Right? We were kind of getting bearish, but that kind of ended, and you can see today is we are well into the cloud now on the Qs. IWM is actually still below the cloud. Price is back below the red line's back below, so we're lower now than we were 26 days ago. That's how bearish we were, and we were noisy, and now we're headed back towards being at least weekly bearish here. So really important levels to kind of watch. Your S&P Bollinger Bandwidth in the middle, nothing too crazy there. The Qs are not in the middle; they're in the lowest part. When you look at the trend strength indicators, or excuse me, sorry, not the trend strength, the TTN. There we go. When you look at that, you can see the Keltner channel. The bandwidths are actually the bands are still inside the Keltner channel. So we still have that breakout potential for the bands to get outside of the Keltner channels. Which is what happened on IWM previously. Then we had this squeeze where the bands got back in, and now we're back towards the lower quartile of the bandwidth. A pretty big bandwidth, but we're in the lower quartile, just barely, of the bandwidth on IWM. So just like that, we shifted from being relatively bullish to now back to being pretty bearish on the Russell 2000, at least on these particular charts. Here's your directional movement index for SPY. Your negative is right back above 25. You're still pretty high on the positive, so we're not out of the woods yet, but your negative is above 25, and so it's same thing on the Qs. The positive is below 25 there, and then IWM, you can see its negative is also flirting with getting above 25 again, and that's intermediate levels. Getting above 25 would be bearish intermediate levels. Let's take a look at today's intraday move. And you can see like the sell-off occurred after the Fed minutes. That's the biggest driver. We'll talk more about that. We started to fill in that gap over there. We are at the point of control for the 4 weeks. So we're still kind of, again, the inflection point, right? We're still kind of there. The Qs, not the case. We are well into the lower half of the chart now. We are below the value area. So 70% of the volume in the last 4 weeks is now above us. That's bearish for the Qs. IWM, we are just flirting with the lower half, but well below last week's low point now. That wasn't the case until just now. Now we're well below last week's low point, lower high, lower low, and you can see where we need to get below the value area there, which would start to fill in that gap from the Tuesday before Christmas. If you look at, again, today's trading range and volume, the range was 9.7 points, so above average. The volume was about 100 million, so above average too. But you notice neither one of those numbers are strongly above average. 9.7 is well off the charts. So that's a pretty decent number. That's about 2%, right? And that's about, again, where intermediate pullbacks end, is when the average here gets up to 2%, when the ATR itself gets up to 2%. So, but that's not too extreme of a number. It's pretty big. The volume definitely is not an extreme number. 100 million is still, I mean, that's a high number. It's above average, but it's not that high, right? So you can see like these lines starting to turn up there. And the other interesting thing too is volatility ramped up here and got up to almost 20. But you notice we had been so extremely low that it's actually still pretty oversold. Volatility is still oversold. So, if this is going to turn into something more, which, again, today's move would suggest, because you just don't get 3% drops out of for nothing, and almost 2% on the S&P, but the Qs 3%, IWM 3%. They just don't like, they start bearish pullbacks, or in this case, new legs of bearish pullbacks. So you just don't get 3% moves for nothing. So you get those in bearish bearish moves, bearish trends. In this case, a bearish trend for the Russell because it's gotten to those lower lows. So so that would definitely suggest that we are leaning towards more volatility, which, as you can see, for it to get up to 100% or higher, which is where it gets to when you're in these pullback modes, these intermediate decline modes, I guess would be a better way of saying it. We're talking like getting back up in the 30s again. That's still a long ways away. So as bullish as volatility was at the end of the day today, if we are in intermediate decline, if we get past that tipping point tomorrow, then we've got a long ways to go for volatility to go up. So, and I think, again, tomorrow's a big day. Tomorrow is like, do we get past that tipping point where we don't come back? Right, today got us to that tipping point. We're really, because we were so far away from it, but we weren't really pushing, we weren't trending up. Now we've fallen right back to that tipping point, and a follow through tomorrow to the downside. Which again, if we only had like a 1.5% drop, I probably would have been like, we probably had a lot of selling today in this. But 3% drop, 2% almost on the S&P. Again, nothing's ever 100% or 0% in technical analysis, but those numbers are the type of numbers that suggests more weakness to come. You just don't kind of one-off those things. So we'll kind of keep, again, nothing's 0%. So you can't bank on that completely, but that's definitely the way I'd lean based on how we closed it, especially considering we closed at the lows of the day today. So what do you think? Do you agree with that assessment? You disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you are either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted there. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today. It also tells us you want us to do another video again tomorrow. If that's the case, click that thumbs up icon. Of course, if it's not the case, you don't even have to watch if you don't want to. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have for me? Post those in the comment section down below. Join our website on marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle right there, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, come down here and check out some of these things over here on the right. If you click on this Market Outlook Live icon, it takes you to this page. This is where I do a Market Outlook Live video every day on this page at 3:30 Eastern Time. So that's how you get to it. You can also get to it by coming up here, clicking on Market Outlook Live Trade Review. I review all the old trades that we've already put on. We actually closed out a couple today again. So make sure you check that out to see how we exit the trades, not just how we get into them. And also you can see the archives down there. You can see our upcoming classes over here. If you click on View More, you see our calendar with all of our upcoming classes as well as all of our recorded classes for over 3 years back. So check that out. You can also get to it by coming up here to the top and clicking on Trading Rooms. If you come down to the bottom, hit this heart. It opens up this page. Hit that like button. Also, click the thumbs up icon on this page, this image, and click this like button there. Again, the more you do that, it helps get our content out to more of our followers, people that follow our accounts here. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. All right, so now let's talk about what's driving the price action today. And obviously it was the Fed minutes. It was rising interest rates before the Fed minutes, but then obviously the minutes were really hawkish. The odds of a rate hike have really ramped up nearly to 70%. Let's refresh the page here now that we're past the meeting or the minutes release. But they sounded very hawkish at their last meeting, which is what their minutes reflect. And so the odds of a March rate hike now have really ramped up to the point of now on nearly 70%, over 2/3% of a rate hike odds. And of course, by June, which is kind of where we were just barely starting just a while ago at 0. I mean, look at the historical. We're at 94% now for a rate hike. This 0 to 25 is 25 to 50 level. I mean, if you look at, there's 25 to 50. As of mid-September, it was down to like single digits that we would get a rate hike. And the odds of staying at the current levels were above 90%, as recently as late September. But then you can see now we're down to less than 10%. That will stay at 0%. So it's really ramped up the odds. In fact, the 2-year rate, see the 10-year is still at 1.7%, but the 2-year rate's now up to 83 basis points. Look at that move today. Very, very sharp move just in the past few days. Here's the 5-day chart. You can see we had a pretty big jump at the beginning of the new year, but then a really big move today going into the Fed minutes meeting, and then a few more basis points coming out of the Fed minutes release, excuse me. So that's the big mover, that's the big driver today, and you see how that impacted asset classes here. If you take a look at just today alone and see how things performed. I mean, look at U.S. assets. Real estate was down heavy. The Qs were down big. IWM was down big. SPY was lagging because your Dow Jones Industrials were holding up pretty well. Emerging markets were down, but not nearly as much as U.S. equities were down, holding up value better. Even the S&P, the developed markets doing the best. They were actually up going into that release, but they ended up down by less than 1%. And then you could look at commodities were up too going into that release. They're down. Bond prices were down. They actually stayed down. Yields were rising and they stayed strong. The 30-year yield didn't really rise very much after. Remember, the 30-year yield is less influenced by the Fed monetary policy and more influenced by actual economic growth expectations. And then you can see the dollar was down pretty sharply going into the minutes release. And then now not down as much. And gold, which was up big, was actually ended up down with that strength in the dollar. Let's take a look at some of those. Let's take a look at the 12 grid chart here and see how that dollar performed. You can see the dollar had started down, rallied. Remember, it's kind of a safe haven trade. Long-term bonds, again, TLT reflects the 20 to 30 year, not the 10-year, which is IEF, right? IEF is actually not nearly as bearish because it's got a, I think it's actually still above its 200-day moving average. We'll take a look at it in just a second. But TLT is a different story. You're getting some oversold clusters here at this Fibonacci level. Look at gold. Gold pulling back today, but still above its moving average. But look at everything else. Look at all these other risk-on assets. We saw commodities here. Let's pull up the commodity basket. There's commodities there. There's emerging markets bouncing down. Look at developed markets with a big engulfing pattern. The 10-year yield ramping up pretty sharply the last couple of days. There's U.S. equities, which is kind of what the global market looks like over here on the right. Silver and copper are sideways at best, showing some bearish moves today. So and Bitcoin still on a significant bearish trend. So our risk asset classes not doing so well here. Let's take a look at some of their charts. I mentioned TLT being below its 200-day moving average there, but look at IEF. See, IEF is actually well below its moving. It's not. So IEF is actually more bearish. IEF is, which means the yields are more bullish than the long-term yields are. We are in a death cross environment. The 50-day is below the 200-day. And we're below the point of control for the 1 year. We're below. So IEF is looking really, really bearish here. And TLT is just kind of, right? It's just getting below its 200. You're still in this golden cross. The 30 days still above. Now, we are below the point of control, and we're flirting with that lower end. But there's still some really good support for your TLT that we see on the 1 year chart that you don't see on IEF, right? So things can get really bearish on the 10-year yield, even if risk appetite in general stays pretty bullish. Here's the dollar index, and you can see we're still converging, right? I wouldn't necessarily say that the dollar is just spiking. I actually think it's more converging. Remember, I think the dollar is actually not a safe haven right now. I think the euro is more your safe haven, and your euro has been on this bearish convergence. These lines getting sharply. So I think actually if things really hit the fan, I think the euro will actually benefit more and will fill in that gap than the dollar would, which would be bullish for gold, right? Because when the dollar's bearish, gold would rally. So you'd expect, still some very tight. We're still in this really tight squeezing pattern on gold. You'd expect that to not squeeze so much by the time all was said and done. I talked about some of those global markets. Let's look at their 12 grid. And you can see that, look at China, look at Russia, look at Brazil, look at Korea now. India as really your only emerging market among this group that's not so bad. But look at all these engulfing patterns on the UK and France and Italy and Germany and Japan. Just real bearish patterns there. Starting to work their way down to the downside, and then Canada as well getting back to its own bearish move. So, things are not looking good globally. Today's move is very broad. It wasn't unique to any specific. Remember how I said in the last market outlook video, when you get moves, extreme moves that are very specific to certain areas of the market, you don't really trust them as much. Today's extreme move was not very specific to any area of the market. It looks like everything really got hit hard. Now they might be at different levels, but everything pretty much got hit hard today to different degrees, as you can see across this. If you look at the sector chart here, let's look at the sector comparison chart and just look at today alone. Here we'll go to today. Just look at this today. You can see going into the day, energy materials were holding up pretty well. The dollar was weak, right? So energy materials were holding up well. Your safe haven areas were holding up well. Financials and industrials. Your QQQ names are already struggling with the jump in yields that we already had going into the minutes release. And then they really struggled after real estate dropping down pretty sharply. Interest rate sensitive area. Utilities. Your safe haven areas ended up being the best along with materials and energy. So that gap shrunk by the time we finished, and you can see some of these cyclical areas holding up better because these QQQ names have been just so bullish during a extremely accommodative. So in our class today, in our Market Scholars class, I looked at how the markets have performed during 0% interest rate policy environments with QE, and boy, these areas the market loves it. The problem now is what the market's realizing, in my opinion, is that we are going into a situation where we are not going to have and even if the economic outlook might not be the greatest, inflation levels will preclude the Fed from being able to have such a accommodative stance, such an extremely stimulative and accommodative stance with zero interest rates and QE. So if QE ends as quickly as March and the Fed's raising rates as quickly as March, I think the markets are starting to price that in. And the pace of pricing, the pace of expectations appears to be quickening. Like it was June and it was kind of maybe March, and then now it's pretty much okay, we're going to have it in March. And then the Fed was going to start tapering, and then now they might finish by June. Now it's like they're probably going to finish by March. So the pace of expectations, as always is the case, the market pushes the Fed into their policy decisions, especially to start being restrictive. The Fed never starts being restrictive when it wants to be. It always starts being restrictive when the market tells it to be, and that appears to be the case again right now. All right, so for our trade idea of the day, I wanted to take a look at Xilinx. Xilinx, obviously, in that QQQ type space, right? Showing a bearish pattern here with a really bearish candle today. Dark pink shading in a red line, just barely starting dark pink shading in a red line. Just getting below 6% below its moving average. Very bearish short-term sentiment. The intermediate line not only did not get above 80, it actually didn't even get into bullish territory. It just got above 50 and rolled back over. So pretty bad. The market sentiment, though, looks like it's got room to drop. If you take a look at the long-term chart, the weekly chart for Xilinx, you can see we're just barely getting a red arrow, falling PPO from very high levels, negative differential, pretty decent sized gap between those moving averages there. When you look at the 3 green arrow chart for Xilinx, you can see look at that gap. Look at the gap in volume. I mean, there is nothing that can hold this stock up. Not a moving average, not a level of volume. There's some pretty clear sailing, and the MACD is suggesting that we might just be starting a bearish divergence because this is barely crossing below zero here, and the stochastic's also coming down from from what previously had been bullish levels. You can see its DMI looks the same. We had been so bullish, now with the ADX is still pretty high. Now not so much, right? Your RSI and your CCI had been so bullish. Now not so much. Now they're getting into the lower halves of their charts at very similar tipping points that we talked about. You look at it's finally in the cloud. See, that bearish move didn't get you in the cloud. Now we are in the cloud. The green line's below the blue. We are well below both. Starting, haven't even started the bearish trend yet on this chart. And then you look at like the Bollinger Bands, and I told you about that volume gap, and you can see that's where the value area is still way down there. So there's still, and we are in the lower quartile of the bandwidth. There is still a lot of room for this stock to go. If it does drop, there is plenty of room for it to go down to the downside. So what I decided to do here was to buy a put, buy the at-the-money put with 45 days out. So it's, the problem is I don't have another contract. I can go out to March. I probably could have gone out to March there, but I'm thinking more shorter term on this trade, because when we fall pretty hard. But if we get down there, if we get down to the levels here, down to this 153 or 160 in this area, here in the next little bit, and we put a 50% stop order, then we can keep our risk to less than our normal risk, and we can get a pretty decent reward, over 2-to-1 reward, if we get down to those levels. And we can, unlike a long put vertical spread where we'd have to stay down there to reap the benefit, as soon as we touch that level, we can reap the benefit of this long put. That's why I decided to do the long put here instead of the long call. The implied volatility was already really high. And you can see the big extreme move here. So I'm banking on a quick move to the downside if we get it, because of that big gap in volume and price, and then taking advantage of it as soon as we get it, and closing out the trade to try to lock in what we got out of it. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. It's available for all of our free subscribers as well. Remember to click that thumbs up icon, like us on Twitter and Facebook, subscribe to our YouTube channel as well as our website at marketscholars.com. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.